Nvidia CEO Jensen Huang talked about two catalysts that could lift Nvidia's demand significantly higher, even from certainly elevated levels they are today, compared to 2.5 years ago, where they were generating revenue on an annual basis of under $30 billion, and now they're doing over 40 billion every quarter. So they've grown significantly, but the CEO feels there's at least two catalysts that could drive the company further higher from where it is today. And I wanted to discuss those in this video.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So these comments were made during Nvidia's most recent conference call they held with Wall Street analysts after the stock markets closed on Wednesday, May 28th. And I get these transcripts from finchat.io. They aggregate all of the financial information from all of the companies that I'm following all in one place. It's very convenient for me. I like their service. You can get a free 2-week trial in the link in my description to this video. So Jensen Huang said that reasoning is compute intensive and requires hundreds of thousands more tokens per task than previous one-shot inference. And reasoning models are driving a step function surge in inference demand. So let me break this down, what it means for Nvidia stock investors. People are using large language models more and more nowadays. They've grown to over 400 million monthly active users. But not only that, people and businesses are asking these large language models to answer more complex questions. And those complex questions require more thought from these large language models. And that increase in thought means there's more computations going on behind the scenes. There's more searching, there's more connecting, there's more trial and error, and all of that requires more computing power, which is great for NVIDIA because that's what NVIDIA provides, is that accelerated computing, which makes all of this possible. And so if there's increase in engagement with these large language models, there's going to be an increase in demand for NVIDIA's GPUs. And this step function increase is great because a year ago, that wasn't where the large language models were focused. They were just focused on simple inference, and a question and an answer that comes out relatively quickly. Now, if you go to ChatGPT, you can do a whole report and ask the question, and the large language model will take 20 minutes or so developing a whole report on the question that you want answered or on the topic that you want a report on. And so that increase in search activity, that increase in engagement, is a catalyst for NVIDIA that could drive revenues even higher from where they are today, which, as I shared with you in the introduction of the video, NVIDIA formerly reported $27 billion in annual revenue. And in the most recent period, that jumped to 149 billion. And in fact, they're forecasting revenue of 45 billion in the upcoming quarter. So they've grown significantly from where they were just as recently as 2022. And the CEO sees more catalysts ahead that could drive their revenue even higher from here. Right? The next catalyst is more of an overall stock price catalyst than a revenue catalyst. And that is the diversification of its supply chain. Right now, there is significant risk associated with NVIDIA stock because of its dependence on the supply chain outside of the United States, most notably its dependence on Taiwan Semiconductor Manufacturing Company, which is based primarily in Taiwan. It has manufacturing outside, but primarily it's in Taiwan. And of course, President Donald Trump is increasing tariffs on countries outside of the United States. So NVIDIA would like more manufacturing capacity inside the United States to alleviate that big risk. So already Taiwan Semiconductor is building 6 fabs and 2 advanced packaging plants in Arizona to make chips specifically for NVIDIA. The process qualification is underway with volume production expected by the end of this year. And in Houston, they're partnering with Foxconn to construct a 1 million square foot factory to build AI supercomputers. So this is great news, and why this is a catalyst for Nvidia stock investors, because there's risk associated with Nvidia stock. Let me share with you my proprietary discounted cash flow valuation model. And within my valuation model, of course, I calculate a weighted average cost of capital, and that's where I incorporate the risk for the business. And Nvidia is a relatively high risk business. It has a beta of 2.11. That's a measurement of risk. That measures the percentage change in Nvidia's stock price compared to the percentage change in the S&P 500 index. So Nvidia's stock price moves more than double that of the S&P 500. So it's twice as volatile as the S&P 500. And all else being equal, investors prefer lower risk. So if a company is going to have higher risk, then investors are going to pay a lower price for that stock. So if a business can lower its risk, it has the impact of raising the stock price, because this whole discounted cash flow model, right? So I forecasted free cash flows from the year 2025 all the way out to the year 2035, right? But because these are free cash flows expected in the future, I need to discount them. I need to discount them to the present value. And the discount rate I use is 14%, and that accounts for the risk in the business. The weighted average cost of capital includes the measurement of beta, which is included in the capital asset pricing model, cost of equity of 16%. So if Nvidia can lower its risk profile and thereby decrease the volatility in the share price, it'll reduce that denominator, that weighted average cost of capital. That it's not only me that's using this is my own proprietary model, but investors use versions of this of their own making throughout their process of evaluating stocks. In fact, nearly every finance class that I teach at university, and I teach several finance classes all the way from the introductory finance course at university all the way up to master's level courses at the university. And in every course I teach, I have a valuation model that I teach to the students. It's part of the learning objectives of the university to teach students how to value a company using the present value of future expected free cash flows. And so this is a core teaching for every finance student. And of course, finance students eventually graduate and go into, some of them going to finance companies and start off their own firms and invest their own money. And they probably use some version of a discounted cash flow model to generate the value of a business, the present value of a business, a fair value of the business. As I've done here with Nvidia, I calculated its fair value to be $128.50. And the discount rate is the denominator that discounts all of those cash flows. So if this rate goes up, then the value of the stock goes down. And there are many components that go into that weighted average cost of capital, but one of the bigger components is risk, and risk measured by beta. And so with Nvidia diversifying that supply chain, Taiwan Semiconductor building out the US supply chain, that de-risks the business. And so I wouldn't be surprised, not in 12 months, but if in 24 months, because 12 months, they're still just uh, qualifying these plants and getting them up to speed, right? It's just now starting. And then it's going to take probably a year. So by the end of the second year, in 24 months, NVIDIA stock investors will learn more about the supply chain inside the United States, the cost differences, right? Because it is more costly to produce in the United States. How much more costly? Investors will want to know. And from the early signs, it looks like the costs are not going to be that much higher. And the risk reduction that comes from the US manufacturing, it seems like is more than enough to justify bringing production back to the United States. So you're getting an offset in the risk to offset the impact of the higher price per unit to produce these components inside the United States instead of producing these components outside the United States, where you get them at a lower price, but it also comes with higher risks. And now with all the tariffs and the threats of tariffs, it's almost a better decision for companies, if they have the capability, to do it in the United States. And that's great news. And that's going to be a catalyst that could lift Nvidia stock price higher in the next 12 to 24 months.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.